appreciated to 160 shillings against the dollar. Yeah, so we took a number of measures, confidence-building measures. Can just mention a couple of them. One was that there was a lot of concern in financial markets last year whether the government would be able to pay a $2 billion Eurobond payout that was due in June last year. So the markets were very, very nervous. So what we did is last year in February, we had a liability management operation where we issued a Eurobond specifically to largely finance this Eurobond that was due in June. And that really calmed down the markets. Issued an infrastructure bond also that raised 4 times what it was aiming to raise. Half of it was foreign subscribers into the bond. That brought in a lot of forex. Of course, the tightening actions of monetary policy also helped. And then we did forex reforms. Basically, forex reforms that were aimed at enhancing price discovery. Price discovery in the market, a B-match system, where there was matching between buying and selling of foreign exchange and making the whole system more efficient. So all that contributed to stabilization of the exchange rate. For now, almost 9 months, it's been around 129, 130. And unless there are any major shocks, the exchange rate probably will not go too far away from there. Although, of course, it's market determined. It's a market determined exchange rate. So it can move around, but the central bank can come in sometimes to manage excess volatility of the exchange rate. So if you have chances of excess, then it can come in. But it seems to have stabilized. That rate of 129 seems to be a good rate for exporters and also a good rate for importers, 129, 130. Okay, and it's created a lot of certainty in the market as well. One other major achievement was at the beginning of last year, our foreign exchange reserves had dropped to about $6.5 billion. That's around 3.5 months of import cover. And we aim to have about 4 months of import cover. So what we did when the exchange rate stabilized, the central bank went into the market and started purchasing forex to build reserves, to build an adequate buffer of reserves. And we managed in a year, together with some support from IMF, but mostly purchasing from the market, to increase the reserves by 2.7 billion, actually in a 1-year period. So the reserves are now at about $9.3 billion, about 4.8 months of import cover, way above the minimum target of 4 months, way above the EAC convergence target of 4.5 months of import cover. So we're very comfortable in that regard. And that's also one factor that contributes to the stability of the exchange rate. When you have adequate reserves, then there's a sense that even if you have some shocks, temporary short-term shocks, the central bank has the capacity to be able to intervene and mitigate excess volatility. So I'd say those have been some of the highlights. Otherwise, the global economy is getting more and more difficult. Last year was quite a difficult year. The global economy is estimated to have grown at about 3.2%. This year, we expect about 3.3% growth, and next year also 3.3% growth. Kenya, the economy previous to 2024 figures haven't come out yet, but 2023, we grew at 5.6%. Initially, last year, we had projected 5.1%. But as the year developed, it became clear it was going to be a very difficult year, growth-wise. So we revised our projection to 4.6% for last year. But KNBS will officially release the growth figures around April. End of April, they released the economic survey. But we knew already from the third quarter, when we had the third quarter growth of 4%, we knew it was going to be a very, very difficult year. So one of the other justifications for easing is that private sector credit growth really slowed down towards the end of last year. And I want to help promote private sector credit growth. as well, so as to be able to spur economic